Time for the word on Wall Street. Top investors watching your money. Joining me now, Michael Lee strategy founder Michael Lee and Mark Tepper here with us on set. So, Mike, let's kick things off with you this morning. We do have a different story today as far as futures go. We've got the Dow up 69, Nasdaq up 90, S&P up 17. It was a rough week last week, as we all know, a lot of red arrows. But we're getting CPI out this week. The CPI is out Wednesday. PPI retail sales come out Thursday, Mike. What are you expecting from these numbers? In particular, really, I'm calling it CPI week here on Fox Business because I think that's going to be a pretty blockbuster report Wednesday.
You know, it's unfortunate that the two numbers aren't flip-flopped because the PPI typically leads the CPI, and we've seen a dramatic fall in the annualized rate of inflation over the last 6 to 9 months, and a lot of that had to do with the price of oil coming down from $80, $90 a barrel down to somewhere in the 60s. We're now back at that 90 number, and we've been back here, and so at a certain point, that's going to affect everything. And I know we look at core CPI and core PPI, but the price of oil affects everything. It is a key driver for inflation. It's the Biden administration's policies on fossil fuels have been a key driver to the inflationary super cycle we've been in. So at some point, that's going to tick back up. That's starting to hit expectations. And if it's not this month, it'll be next month where we see an upside surprise. And it'll be interesting to see what happens to Fed fund futures from there, because there's a lot of, right now we're looking at about 50-50 odds of another 25 basis point rate hike. I personally think that's a mistake. We've gotten close to 400 basis points of hikes within the last 12 months. Those can take 18 to 24 months to actually hit the economy. So as we're seeing a slowing across the board, credit card and auto loan delinquencies on the rise, corporate defaults on the rise, interest rate coverage ratios declining for investment grade and high yield companies. So as we're seeing that slowing, we're going to get additional rate hikes, which I think increases the likelihood of a recession at some point early next year.
Okay, early next year, the word recession is back. So much for soft landing, because that's the debate that keeps on going. Mark, let's talk jobs at least. You've got Goldman Sachs planning their 4th round of job cuts. That things are not still as rosy as we would like to see with the banks. You've got UPS basically reportedly they're going to cut a bunch of wealth management jobs in Asia at least. There's UBS in the pre-market. Mike, jump in here.
Yeah, look, in this, when the yield curve is inverted, it is not good for banks because the idea is you borrow overnight and invest long, right? And so when short-term rates are higher than long-term rates, it becomes very, very difficult for traditional banks, for investment banks to make money. And so in this difficult trading environment, you not only have a hard time trading, but when that presses equity valuations, companies aren't trying to go public and be a cheap investment. They're trying to get the maximum valuation they possibly can. So when those are depressed, it depresses the underwriting fees from that, as well as mergers and acquisitions. I mean, who wants to sell their company on a downturn? So it's everything kind of, these businesses are highly correlated to the overall economy, and to see Goldman take a step back from their consumer finance business is a bit surprising, given how they've basically been successful in every other venture they've ever taken on. Yeah. So it just goes to show you that being an ultra high net worth bank, being a #1 M&A bank is not the same thing as doing retirement planning for Mr. and Mrs. Jones.
The higher you're up, sometimes the farther it is to fall, right? Mike Lee, good to see you, Mike. You're not falling. You're always with us. Thank you, sir. Mark, you're going to stay with us all morning long. Leave it on a positive note. All right, coming up.